my name's Miles Pitcher. I own Superior Lending. This is our 21st year in the business, and we love helping our clients. We love showing them different options. And this is one of the most innovative, cool loans that I've ever dealt with or found. I personally use this loan on my primary residence and one of my rentals. So very, very cool. So it's called the all-in-one loan, and let me walk you through it. So to get the mindset right, let's think about this for a little bit. Let's say that you are self-employed, you have rainy day funds that you set aside. Why don't you just dump those into your current 30-year mortgage and pay it down? The logical answer there, the usual answer is, once I do that, I have no access to those funds anymore. I lose my liquidity. Doesn't help you for the rainy day funds. The next question is, on a 30-year mortgage, how many years does it take to pay down half the balance on your mortgage? It's somewhere around 20 years into the mortgage. And then the last question, think about this. What's more important to you, the interest rate on the loan or how much you pay in mortgage interest? For me, it's how much I pay in mortgage interest. So as a guy who sells mortgages and puts people into loans, 30-year loans, I'll be one of the first ones to say there are flaws with the 30-year mortgage. First of all, we know that when you pay in, you have no liquidity. The second thing is that, you guys know this, that first mortgage payment you make on your 30-year mortgage, it absolutely is loaded heavy in interest and very little goes to principal. Think about the banks. They love a 30-year mortgage because it is so interest loaded. And on average, people are refinancing. I think it's changing, but it's pushing somewhere around 7 years that people are typically in a 30-year mortgage before they either refinance or sell that home and move on. So it really loads that interest up front. The structure of a 30-year mortgage has been around since 1930. It's great for being a forced savings plan for people, and it's been great for helping people to achieve home ownership, but there are definitely some flaws with it. So our new all-in-one, and it's not new, but it hits three things. It gives you flexibility, liquidity, and it will save thousands of dollars in mortgage interest in the right situations and cut off many years off of that 30-year mortgage. So what is it? We call it an offset mortgage or an all-in-one. Historically, it's been around. The name in other countries is an offset mortgage. So as mentioned, the purpose is to cut down the interest and pay the loan off faster, more comfortably, and give flexibility and liquidity to our clients. So this has been around forever, for a long time. Australia, New Zealand, Europe, and Canada all do these types of loans. Western Europe was really the first spot that did this. It actually is around here in the United States for commercial loans. They call them zero balance or sweep accounts. So while it's a new product in the United States, and we're talking since 2005, it's been around, the concept, for a long time. The concept came and was created by someone who saw this loan in Australia and said, this would be phenomenal in the United States. So the offset mortgage works this way. And it takes it, and this is how it works in other countries. The idle cash that you have sitting in your bank, a savings account, sits there and it's earning a low amount of interest. But what it does is it lowers or offsets the mortgage balance, and that has a high interest cost. So if the 800,000 is owed, there's 100,000 in the bank, you only pay interest on the 700,000. And that's what an offset mortgage is. The all-in-one loan tied together two very, very powerful financial tools when it changed from the offset mortgage to the all-in-one loan. First, we replaced the mortgage with a first position HELOC. Okay, and it has to be a first position. Then we tie the checking account at an FDIC insured bank to that home equity line. It has all the features of a normal bank account, ATM checks, bill pay. It's a secured, normal checking account. Built into there is a sweep that moves funds back and forth between the checking account and the home equity line. So every single night, any deposits that come into your checking account, then whatever's left in balance, I'll say there's $100,000 left in that checking account, it will sweep over and lower down the home equity line balance. And that creates equity in there. On the same or the flip side of the coin, if you use your debit card, the bill pay, or pay off a credit card with it, the money sweeps back out of the HELOC to the checking account to cover those bills. This happens every night at midnight. So the fundamental principle here is that money that is not spent is always working to keep your HELOC balance lower, thus reducing the amount of mortgage interest that you are paying. So here's some of the benefits with this, and we'll go into some more details here in a minute, but I've mentioned the mortgage interest, how much we save, okay? This says build equity 2 to 4 times faster than traditional loan. I know that's true. Pay off your mortgage in half the time. The nationwide average on this loan product is people are paying off their homes in 11 years. My clients that we've done this for have an average of 5 years, 5 to 7 years, in that range. It's a 30-year HELOC. You have access to liquidity for 30 years. And if things get tight or tough, you can just pay the interest only. Here's some of the features that really make this phenomenal. Number one, money goes, when you make a payment or a deposit into that checking account and it sweeps over and pays down the HELOC, it goes to pay principal first, compared to a 30-year mortgage where you make that payment and it goes to pay interest, fees, and then last of all, principal. You can make the deposits at any time you want, any amount, any frequency. They become usable equity in the home. So that means that once you pay into that or you have deposits come in, you can draw that back out when you need it. You can withdraw for up to 30 years, and I'll show you the details on that. And then this is one of the big things is this is simple interest. It's not amortized interest. So every single night they calculate the simple interest on the mortgage balance. So can this be used for a refi and a purchase? Absolutely. Loan amounts up to $2 million. Typically, we're doing these at 80% of appraised value. We can go to 90%, but like with most loans, once you get over 80, you have to deal with the mortgage insurance. And so to get that extra 10%, you have to buy out or pay for we call it a single premium mortgage insurance. I'll share some examples here in a minute of when we've gone to 90%, but most of the time we're going to 80%. We can do this on primary residences, second homes, investment properties. Pretty awesome. 20 to 30 days after you close is when you get access to the banking features and totally have those ATM, the online banking. It's a normal bank. And by the way, there's 2 banks that we work with in doing this. They are great banks. They have been so good to work with. One is North Point Bank and the other is Merchants Bank of Indiana. I would say the only disadvantage to those 2 banks is I'm in Utah, we're in Utah here. We don't have a local branch. So if you need a cashier's check, you can't walk into a branch and get a cashier's check because there isn't a branch around. But you can call them up and order a wire, and they have like personal bankers who are there to help you, and they make it really, really easy. We have a question here about, can you do it instead of a reverse? So this is a great option to look at for somebody who would be in a position to do a reverse mortgage. The reverse mortgage is for where we have someone 62 and older and they have lots of equity in their home. That fits a need of people who need better cash flow. This becomes a great way where somebody has sufficient income, they can still qualify, but they want access to their equity and want to pay less in interest. So it really fits 2 separate needs there, but it is a really great option for some of our seniors who are in a strong financial spot, but really like having access to that equity. All right. Let me show you this. Trevor, that's a great question. I will hit that here in a couple minutes. Here's the structure of how it works. You can see that for the first 10 years, your credit limit, I'm not talking loan balance, I'm talking your credit limit. Let's just say 80% of the appraised value. It remains unchanged for the first 10 years. Let's assume that maybe this is $1 million purchase. and the client puts a 20% down payment. So they have an $800,000 line of credit. Starting year 11, the credit limit slowly ratchets down 1/240th. So by the time you reach year 30, your credit limit is at zero. This is the structure that allows the banks to feel secure in the repayment of this loan. So if we had an $800,000 credit limit, you would lose $3,333 every month of credit limit. So let's throw in a balance here. You can see how someone may make deposits in, the balance moves down, and then at some point they want to remodel their home. They can draw those funds out, or they have a medical emergency, tuition, retire, they travel. You can see the many different ways that they can draw the funds out as they need. We have 3 different options on this. We have a 1-month adjustable, we have a 3-year fixed, and a 5-year fixed. We have been, in the past, we did a lot of 1-month adjustables. Right now, I'm doing primarily 5-year fixed for clients that are doing this on a primary residence. The investment properties are typically going on the 3-year fixed, and then it goes adjustable after. This used to be based on LIBOR, but it has switched over because LIBOR has been left in the dust because there was some manipulation by people in the past on it. So we now use our index, the CMT, constant maturity treasury, or known as the 1-year treasury, as the index. And then so you have your index plus a margin, and that can range from 2.5 to 3.75. You add those two together, that gives you your fully indexed rate. There is a cap on it, a lifetime cap. So whatever your fully indexed rate plus 6%, that's the max it can rise up to. And then there are floors. So if the CMT drops way low, which it has been last year, it was way super low, there's a floor that you would hit. 3.75 on owner occupied, 4.75 on investment properties. So here's a little diagram that shows the index and the margin. The margin will never change over the life of the loan. The index will fluctuate on a monthly basis after your fixed period, if you're in that 3-year, 5-year fixed period. So in this example, yeah, you could have a 3.25 margin. The index is a 1.13. You would start out at a 4.38 indexed margin. The lifetime cap would then be 10.38%. I just want to show you a chart here. You can see in this light blue, the CMT, where it's been, how it moves kind of along pretty close with the Fed funds rate. And you can see it's been super low over the past year and a half or so. So it is really good. We're happy with the choice that was made, leaving LIBOR and moving to the CMT. We think it will be a really good index for our clients. Okay, so in your traditional mortgage, you guys know this, every payment you make is on a monthly basis, goes to interest first, and it really slowly steps down. In the all-in-one or offset mortgage, you have these big green deposits that come in, and that can be your direct deposits from your salary. Maybe you have a commission that comes in, it drops the balance down, and then your monthly expenses can be drawn out as they come out, because normally our monthly expenses don't all come out at the same time in the month. They're spread out, and then another month hits and you get more deposits. You can see the structure, how that works down. Who is this right for? Salaried people, commissions, self-employed. This is a big one and a big help to them. Retirees or people with good assets. In short, anybody who is good at cash flow positive. We see clients often where we look at their credit report and we see they're maxing out their credit cards, really living month to month. This is not a good option for them. That's where the 30-year mortgage fits for those people. But if you have someone who budgets really well, we've had school teachers who this has been fabulous for. They're great at budgeting. We've done this for a ton of real estate agents and self-employed people, where you may have some really big months in your business and make lots of deposits, pay it down, and then maybe a month or two a little bit skinnier. It really gives you a lot of flexibility. Quote from a guy. So this guy, he's a buddy of mine. He is very successful in the multi-level marketing world, network marketing. whatever you want to call it. This has been huge for him to be able to manage his product in that world, to acquire it, buy it, and then he's had influxes of cash, he's used it to pay it down. So I've had another client who runs you've seen those Snap-on tool trucks. He keeps this big old chunk of cash as a rainy day fund. He's now been able to drop that in, pay down the mortgage balance, save a ton in interest, but as he needs it to order tools or load up on inventory, he has access to this. It's pretty cool. Okay. All right. Let me make sure I got everything here. Okay. So this is where we'll hit your question, Trevor, and go through a few of these here. So how many all-in-ones can you have? So you can have one on a primary residence, you can have one on a second home, and you can have one on an investment property. So you really can have three of them, but they have to be on those different types of properties. Any prepayment penalty? Nope, not. You can pay this off and leave it open with a zero balance with no penalty. You can pay it off and close it at any time you want. Or if you sell your home and this is on it, you just order a normal payoff. It shows up as a normal mortgage lien on the property. This is a question really that I think is key, is what I'm sure some of you have heard of doing first position HELOC loans in the past. What makes this better than a first position HELOC from a local credit union or bank? I would say number one and foremost is that built-in sweep. That ability to have, all you have to do is deposit funds in the account and it sweeps over and pays down the mortgage automatically for you. Number two, this is available for 30 years. A typical HELOC will give you a 10-year draw period. And this is, when I say typical, this is what you would get at the local credit union or bank. 10-year draw period, then it freezes and you have to pay it back over the next 20 years. You can't draw it anymore. So I love that about it. Third, typically this has better rates than a HELOC. Yes, there are introductory rates you can get out of a local credit union and bank that may be lower, but they have generally variable rates and they generally are higher. We also see that this loan product will go way up to a higher loan amount, up to 2 million. And most credit unions and banks really hesitate or have concerns about going that high. The banks, I mentioned that already, North Point, Merchant Banks of Indiana. How long has it been around? It's been in the US. These guys we work with have been doing it since 2005. And this is pretty cool. Since 2005, they have never had a single foreclosure or default on any of these loans. And you think about what that includes. That includes going through the Great Recession of 08, 09. Okay. I got an update this morning that they did have two people during COVID go into forbearance. That's incredible, thinking of how long they've been doing this and how many people have this loan product. The other part of it that I love is that during 08 and 09, a lot of credit unions and banks either reduced people's credit limits or froze their HELOCs that they had. This all-in-one, they never reduced a single person's credit limit nor froze any of their HELOCs or any of the all-in-ones. So it has a fabulous history and it's gone through some times that have really tested it. And I love that track record. Is this allowed by the IRS? Yes, it is. Is the interest tax deductible? So obviously that's a question for a CPA, but the IRS code right now reads that first position or first mortgage interest may be deductible. If you choose to go with the standard deduction, then you don't get to use it. But if you're itemizing, yes, you can use this interest as a tax deduction because it is a first position mortgage lien. Can it be used on commercial properties? No, but we can use it on multi-unit properties up to a fourplex. So duplex, triplex, fourplex, yes. Let's say your home is paid off and you want to put one of these on your home. Can you do that? Yes, but they have an initial draw minimum, which is going to be around $60,000. So they just don't want to give this to you without a draw coming out. You would refinance into it and then you'd have to tell them, hey, I'm drawing out $60,000 to invest in the stock market or whatever it may be. We had that with a real estate broker that we worked with. He had his house paid off. He did one of these, loves it, but he had to draw out some money to use as operating capital for his business. Any monthly annual expenses, obviously there is the monthly interest, it's interest only, but if you pay it to zero, the only annual fee at that point is a $75 annual fee. Closing costs are typical and in line with a normal refinance or purchase. There are origination fees that are charged, and those can vary from 1% to 2% depending on how big the loan amount is on there. By the way, I should mention on the closing costs, they do not do an escrow account or prepaids. That's where we hold the lender holds property taxes and homeowners insurance and pays those for the client. Think about the principle here. Our goal is to keep our mortgage balance as low as possible, as long as possible. So they let you, as the client, if you have an all-in-one, pay your own property taxes and homeowners insurance, because you get to hold that money in your all-in-one, reduce your balance, and then when your taxes come due in November, you can write out the check and pay your taxes. Can you close in an LLC? No, you cannot, but you can move it into an LLC after you close, assuming you are the majority owner or have controlling interest of the LLC. A full doc loan, what that means is they are going to underwrite to Fannie Mae guidelines, though this is not a Fannie Mae loan, and they will require full documents. So self-employed people, 2 full years of tax returns required for that. Are there reserve requirements? Yes, there are. These are going to be from 10 to 15%, depending on where your debt ratios land at. And that needs to either be cash and bank accounts or retirement accounts. You cannot count the funds that you're drawing out of the all-in-one as reserves. Is there a limit on the number of financed properties? Yes, 6. Once you go to number 7, you have to request an exception. They are granting exceptions now. It's a case-by-case basis, but during COVID, the banks were not granting any exception. Is there a prepayment penalty? No. How does this report to credit? So the way it shows up on your credit is as a normal mortgage, and then it will show what the prior month's interest is. So whatever that balance was prior month, it will show up. The monthly payment is how much the interest was from the prior month. I hope that makes sense, Trevor, on there. That's answering your questions about DTI. So yeah, it does get counted in your DTI for future qualifying unless you've paid it down. We've talked about the credit report, or how it reports there. How long does the process take? So purchases we can get done in 30 days. Refinances, they don't prioritize them as much as the purchases. So you're looking 45 days plus on those. Somebody asked, can you link a business checking account to this? Great question. So because I know a lot of people like to move their investment properties into an LLC and operate a business checking. So you can open up a business checking account at the same bank. And this is what I've done at North Point Bank. I have my business checking account there. There is not an automatic sweep tied between the business checking and the all-in-one. You have to do that as a manual move. Since this loan is given to you as a personal loan, the personal checking account is where the automatic sweep is tied in. But I like having my business checking there, and I can move things in between those businesses. Declining income, I mentioned this, I added it just so I don't forget. Declining income is where, let's say you're self-employed, 2020 was a great year, 2021 was even better or equal to, and then 2022, your numbers are down a little bit. That's what a lender considers declining income, is where you're not on track for the prior year or surpassing it. On this loan, they get picky about that. If you have someone with a declining income situation, let me talk to them. I'm not saying no to those people, but it's definitely something we've run into with some of our clients on there. we want to help them out on those. A lot of people talk about velocity or infinity banking. Many times that's done with credit cards and shifting balances around. I'm no expert in those, so this is really not infinity or velocity banking, but it is super, super powerful. And then non-warrantable condos, yes, you can. It does take a case-by-case approval on those. I do want to mention, I'm not sure where I skipped it at. Credit scores need to be over 700 on a primary residence, second home, over 720 on investment properties. Debt ratios are a little bit tighter than normal Freddie and Fannie loans. This, by the way, this is a portfolio loan, so it is not sold to Freddie and Fannie, which is cool. Debt ratios need to be 43% or better. As you can start telling, they take the best of the best clients on these. They really don't, well, that's why they have such a great record of no defaults, the best of the best clients on there. I have a question here. Can someone use 100% equity in a paid off home to purchase a new home and move and sell? So I think that question, I assume meaning somebody has their home paid off, they put an all-in-one on it. Can they access and grab that equity to then go purchase a new home and use that as the down payment on the new home? Yes, they can. That no problem with that, because there's no prepayment penalty, and the bank doesn't, when you have an all-in-one, nobody's watching you or saying what you can or can't use those funds for. It is all up to you. You essentially become your own bank. I forgot to mention one more thing. One thing we love about this is, I mentioned you could go up to a $2 million loan on this. There is no jumbo or conforming loan limit in this product. So going up to 2 million is fabulous, especially as we see a lot of our clients now moving up into jumbo range loans. So totally love that about this. When COVID hit, the jumbo loans really disappeared or got really hard to get done. This is a great solution for our jumbo range clients. All right. So I'm going to hop over to you guys. This is one of the cool things here is a simulator that we have. This is where somebody who's interested in this or just wants to see, does it make sense on the numbers? You get to plug these in and it's pretty cool. So I'm going to hop over and take you guys through the simulator. So let me go to, this is on my company website. So it's superiorlending.net, and then up under loan programs, you click there and then there's, oops, jumped on me, all-in-one loan. And then there's a little blue box. You can click on simulator, and I will, let's see if I can make that just a touch bigger. Okay, so this is where we start. And typically I like to talk to a client, explain the all-in-one, and then walk through it with them and set it up. And then we're able to save the scenario, and then they can come back in and play around with it. But getting it set up is, I like helping them do it. They, of course, can do it on their own. But we're going to start a new simulation, and we are going to compare it to a new loan. We're going to assume our client's buying $1 million home, and it will be a primary residence. So we'll put in the home value of $1 million, not 100,000. We'll add another zero in there, and we'll do an $800,000 loan. This is a loan I quoted out last night to someone. Interest rate 4.375 right now on there. And you can see it automatically tells you what the principal and interest on that 30-year mortgage is. If you're making extra payments, you can throw something in there, or if it's an existing loan you have, they'll allow you to put in here how many years you're in or months you're into that loan, so you can compare it. There is an option here for a second mortgage. So if you do have a HELOC already, a small one, you can account for that by clicking on that button. So the next tab we look at is our deposit. This is not what our gross is, but we want to look and see on a monthly basis, what do we have coming in after taxes? What hits our bank account? So I'm going to throw in here that our client makes $120,000 a year, or, well, they make more than that, but let's just say they have $10,000 a month coming in every month. If we have a client that has like stock options or a year-end bonus, you can throw that in there and say that comes at month 12 and add that in. Very, very cool to add that. Down here at the bottom, there are repeating deposits so that if you have additional things coming in, rents off other properties or whatever it may be, you can add those in and account for those. So we've looked at our deposits. Now we're going to look at our spending. And we're looking at the household expenses here, okay? We're going to take into account what the mortgage, the 30-year would have been, and then we want to kind of see what's left over after covering household expenses. So typically I'm finding most clients, if they have 25% or more left over, this makes sense. I'm finding a lot of these clients have +% left over or more. It does estimate taxes and insurance on the home. This number should be high for Utah. It's a nationwide average. So it's okay to be conservative. You can't change that number in the program here, but just know that it's accounted for. If you want to go into a deeper detail on this, you can click over here on itemize, and then you can throw in weekly, monthly, regular expenses, other things to throw in there and account for. But I like just being quick and trying to figure out. So our client right here is going to have an extra $3,000 left over every month after their household expenses. Then we hit calculate results. So this is pretty cool. We got our all-in-one on the left. We got our traditional here on the right. Our all-in-one is projected to be paid off in 13.8 years. Total payments on here versus the 30-year would save $280,000 to our, pretty powerful. And the client's going to have access to that line of credit, the $800,000 line of credit for 30 years. Yes, it does diminish the last 20 years, but still access to it. A couple of things to note here, rate and assumptions. So right now this is set at a 1-month adjustable. If we come in and throw it at a 5-year fixed, and this is the highest margin there, right now you can see that the index, they're projecting or saying it's increasing to the average, or you can choose stable at current rates. So the increasing to the average puts it higher than where it is right now. So it's more conservative. We just shaved off more years by going with the 5-year fixed. And now we're up to 333,000 saved. Let me show you the pay down summary here. And a couple of key things I love on this is over here. This is one I love, is the break even rate. So this says, how high would the adjustable rate on this, right, the index plus a margin, have to get for it to be equal to or worse than the 30-year mortgage? And it would have to rise up to 8.6%, which is pretty high. I love that number. That right there is one of the things we look at with our clients to see, does this make sense? This pay down table is pretty cool right here. All-in-one is over here in the blue gray, and then we got the traditional mortgage, the 30-year to the right. If you scroll down to where it's paid off, you can see that what year and month it is and what balance is still left on the 30-year mortgage. You would still have $572,000 left on that 30-year mortgage the year you paid off this all-in-one or paid it to zero. Pretty crazy to think about on that. And that's assuming the client is being able to repeat that $3,000 extra every month being left in the account, reducing the mortgage interest. Okay. So this is the simulator. Up here in the top corner, you can save and share it. When you do that, you just put in if you create a profile, all you have to do is put in your name and your email address, give it a name, and that just allows you to, all you do is you put in your email address and then you're able to view it again and manipulate, and you can save multiple simulations in here also. If you want to do one for an investment property, do one for a primary residence, you can have multiple simulations in there. Let me jump back and walk you guys through one example here. Okay, so this will be repeat a few things we've covered already, but let's just say we have an 800,000 mortgage, conventional versus offset, and 30-year loan, rate 4.5, and then this is 5.2. It's higher than where it is right now, but that's okay for our numbers. We'll assume we got double income family, borrower, co-borrower, and then we've calculated what their annual expenses look like, 138,000. So we start off their loan at 800,000. We have their deposits come in, which is $14,400 a month. Our new balance on that loan is 785. What's awesome is that 14,000 that got deposited is equity, and it's available through these different ways that you can access it. So this is the calculation on the simple interest, right? It's taking our balance, the interest rate, you divide by 365, and that tells you how much 1 day of interest is, $114. With that $14,000 deposit that we made, we just reduced our daily interest by $2.07. That's $755 in 1 year saved by just making that one $14,000 deposit. That assumes that the balance would be steady through the whole year. When are payments made? Well, interest is calculated nightly on what the balance is at the end of the day. When interest comes due, it just totals up the prior 30 days, and they automatically draw that interest out of the all-in-one loan. You don't have to write a check. You don't have to make a payment. They just take it out of the balance. If you have no balance or no equity left in your all-in-one, they would call you up and tell you you need to make a deposit. They're pretty cool. And in fact, this is how cool they are. I did this for a realtor who was using it to fund the remodel on his home. And he didn't realize that he had written out more checks and paid more than he had available on his all-in-one, but to the tune of like $50,000. Merchants Bank of Indiana called him up and said, "Hey, we got these checks coming through. You don't have enough." And he said, "Oh, shoot, man, I'm 3-4 days away from these big commissions hitting that are coming. I'll be able to get the money in." And they said, "Cool, that's great. We'll pay the checks. You just get the deposits in the 3 to 4 days." So they totally covered those, even though we went over. I thought that was pretty awesome of them that they called them up and talked to them about it. Anyways, interest goes on the 21st of each month, and it automatically comes out. Okay, so a little diagram of a month to month in our scenario here. We have our expenses going out. We have our interest, which is $3,400 on that balance. Add the household expenses to it. That's drawn out. You can see our balance now has risen up to $793. What's not spent remain in the account as available equity. This right here just kind of shows you what household expenses may include. And we know that those don't go out every single month. In fact, it's advantageous on this loan product to pay these bills on the very last day so that your money stays in your account as long as possible. My wife and I use it where we use a rewards credit card, put everything on that. And then on the very last day before the interest hits on that rewards credit card, we pay off the full credit card by drawing out of our all-in-one. So we really gain extra time of free interest plus rewards. Yeah, it's all about keeping your money working for you, your deposits working for you as long as possible. Yeah, the mortgage payment that normally would sit in there now helps. It's not being paid to a 30-year mortgage. It's all going to sit in there and help reduce your balances. And then we have our leftover cash. So truly, those items right there are helping to increase the equity in your home and what's available. Just to finish out a couple of months here, so we can see we have another deposit happen of 14,000, then another month of expenses coming out. And now you can see our equity is continually, or another month, it's improving little by little. Month number 3, the pattern repeats. And now we see our equity is at 14,000. This is one I love. 2 years into this, let's compare our progress. You can see the balances between the conventional and the offset. Then you can see at 7 years. Look how incredible that is at 7 years. $253,000 of progress versus the conventional. And then years paid off in this scenario was 13.3 years versus the 30. Pretty incredible on how much that saves you in total payments. $355,000 saved on there. Okay. Any other questions on here? Well, let me finish with one thought and tell you guys how I've used this and just give you some ideas. This can very well be the last mortgage some people take, because at some point when you have enough equity, you become your own bank. So last year I well, it's been a good couple of years in the mortgage business. So I have these all-in-ones. I've been able to pay them to zero. Last year, I bought a rental property. It was awesome. I went in, I was able to negotiate that I would buy it in cash because I just wrote it right out of my all-in-one. I bought the investment property. Then at that point, I had the choice. Do I leave that new investment property free and clear? Or do I refinance it and recapture some of the funds and bring it back in and pay down my all-in-one? On that one, I chose to do so. I bought it at 474. By the time I got the refinance going, it was up to 500,000 in value. And so really what I had to put into that property was quite a bit smaller because of the equity growth. And then I was able to replenish my all-in-one. Now I have my war chest available again for my next rental property. It's pretty phenomenal. Depending on how aggressive you want to get in using it or what you want to use it for, it's there. It's a war chest. It's pretty sweet. Another couple of examples. Like I said, I have a lot of realtors who use this. They love it because realtors tend to find deals. And this gives you the ability that when you see a deal on a property, you can jump in and buy it, whether you're using it for your down payment or just buying it in cash. It's pretty awesome. I do recommend to people that if you're putting this on a $200,000 condo, really it's not the best thing. You don't get a lot of power there. But if you have multiple properties, I always recommend putting it on your most expensive properties so you have the biggest war chest available. Should you do two of them at the same time? If your goal is to have access to equity in those two properties, then yeah, you can do that. But if your goal is to pay them down faster, then do them one at a time. Do your primary residence first, get your deposits focused on that, paying it down, reducing your mortgage interest. And when it's near to being paid off, close to being paid off, then go throw the all-in-one on your next property or on the other one you own. And then you can focus your deposits going in on that second property. Hopefully that makes sense. Like I said, only if you need access to equity on both properties, that's the only time I recommend doing them both at the same time. Otherwise, get one, pay it down, then go get number two and work on paying that down. Okay, we've covered a lot. I'm sure I've left some questions out there. Anything else out of you guys question-wise? Okay, not seeing any posted. Thank you for listening to this. This is a powerful option in my opinion. I personally have used it and seen the power of it. I believe that it's an option, especially in a rising rate environment, that clients need to be aware of. We don't try to sell clients hard on this. We just present it to them, let them see it, and then they can choose if they want to do it. Many can't wrap their head around it and just want the safety of a 30-year mortgage, and that's fine. But at least they're aware of it. Other ones see the power of it and are absolutely thrilled with it and love it. Very, very cool. All right. Have a great one, guys. Thank you for joining on here, and you can follow up and let me know if you have any questions on this. The recording will be made available to you so you can share it. And also just let me know if there's any scenarios you want to talk about on this. Thank you.